Okay, you guys must be seeing the cover of the document explaining the course. I'm gonna go a bit through it and then through the first case. Okay, I think we can get started. So, first of all, thank you very much for connecting. And we are going to cover today the first part of this two-part series on content. In this one is on unit economics, and the next one is going to be on cap tables. So, this is part of our initiative, the Startup Academy, that we started already in September 2021. And since then, we have launched more than 10 editions with over 500 alumni in teaching what we know best, which is startup finance. So we, unlike other webinars, we're going to do a very practical approach. We are going to show you a bit on how the course works and the platform and what you guys can see and what you guys can sign up. And in the platform already, before committing to the course, you guys can see the pre-recorded videos of the lesson one. And today what I'm going to do is probably around half of the case of the lesson one. So between the pre-recorded materials in the Hotmart website that I'm going to show you, plus this live session on the cases and in this case, like the case of lesson one, then you guys can have a pretty big or a good overview of what one lesson is like. Then, as you guys may know already, we have 10 lessons, and they are like this one is like the most basic, an introduction to startup finance, but we're gonna get going on business models, on reporting, and then on financing the startup and running it. In fact, we end with an introduction to the venture capital. I'm gonna go very briefly over these slides about the course, but what do we know about startups? Like, what do we decided to launch a course on startup finance? Because we have already worked with over 300, in fact, 350 startups in over 20 different countries. And always being a team of now, I think, 38 finance professionals that have seen many, many different cases in the last 7 years. So I think that with that knowledge, we know, I hope, a thing or two about startup finance, and that's why we decided to share our knowledge with the community with the startup finance course. As I was saying, 10 editions, 500 students, over 15 nationalities. The objective is to understand startup finance, to understand financing alternatives, to design the reporting tools, to analyze very different business models, which is super important, and of course, to understand the financing rounds. This is one of the most important parts, I would say. In fact, we dedicate 2 lessons to it, and to create a contact network among the community. In fact, today I was speaking with an alumni that he told me that he joined the course half for the content and half for the community, and to create a bigger network. We are pretty proud of the network that we have so far, and you guys will be able to access the database of all the alumni that we have had. The course takes 10 weeks. So I think the introductory session is going to be at the end of February, but it's going to be more on like practicalities. And then like February 27th. And then on March 20th is lesson one. In fact, it's going to be similar to the session today, but covering the whole case because we will dedicate the session only for that. We estimate around 3 hours a week dedication. 1 hour to watch the pre-recorded videos in theory, 1 hour to solve the case on your own, and 1 hour live session. But many people just connect to the 1 hour live session or watch it when they have time, and then they go back to the theory. Like, there's many combinations, and you guys will have the materials for life. And the price of the course is 1,450 euros, payable in up to 3 installments. Who is this for? CEOs and management of early stage startups, startup finance. This, by the way, this is the biggest group. Over 50% or 50%, I would say, of the students are not going to run the finance department in their startup, but they need to know and they want to know how it works. And it cannot be a black box for them if they are a CEO of an early stage startup. Other people that are interested in startup finance professionals, and that makes absolute sense. That is a way to stay up to date and to learn fast if you just started there with a junior position. We have corporate profiles interested in jumping to venture capital or to startups. More on the investor profile, business angels and venture capital, for example, that they want to understand the finance part of it. And in general, anyone that is passionate about the startup world. Who's going to teach it? I'm going to teach, I think, 3 lessons. I think Hubi is also 3. Luis, Fer, and Jordi are 1 and 1. So therefore, Rafa must have 2, I think. I'm not sure if they add up to 10 the way I counted them. And I'm pretty sure it's like that. Hubi, Rafa, and I are partners at the Startup CFO, and we are like the ones that have more experience here with companies in our portfolio. Luis Fer has huge experience both in consulting and in venture capital firms, and Jordi is a partner at Kibo Ventures, one of the best Spanish firms. By the way, even if the 5 of us are Spanish, we're gonna talk. The course is in English, as you guys probably noticed. And we're going to talk about international startups because all of us have worked with international startups. The topics, we have a lesson 0, like no case, no credit on it, fine, on introduction to modeling in Excel, that we think it adds value. We have 1, again, the case I'm going to cover today is this one, unit economics at Uber, for introduction to startup finance, to make sure that everyone starts on the same page and we define the most important concepts that we will be using all along. Then we have 3 lessons, 4 you can consider on business models. SaaS, deep dive on SaaS. Another one on platforms, marketplace, and e-commerce. Another one in other business models, because to be honest, in startups, you always need an other, and many times the business model itself is the novelty. And one that I always thought that this would be one of the boring ones that people wouldn't want, which is startup reporting. And in the end, it's always one that has very good feedback, because I think it's very useful for many people to understand the reporting of a startup and how it should go. And then second half of the course, we move to a totally different part, I would say. I always say that the CFO needs to control the department and to finance the startup. So this is more or less the structure of the course. Funding alternatives, which is everything that is not a funding round, which there are many more alternatives than people know, and many more are popping up. Then 1 on funding rounds and 2 on funding rounds. So funding rounds are very important and very so relevant in the business that we have 2 lessons, 1 on the basics and 1 on the complications. We have 1 that is pretty cool on startup governance, and in fact, the case is a negotiation, so that's pretty cool. And the last one is an introduction to venture capital. In the end, we're going to talk so much about venture capital during the course that we want to see things from their point of view before the course ends. So in each lesson, you guys are going to have some pre-read, some theory videos, some slides, a case statement, a case resolution, and a live class video. So how does this look for you guys? So, okay, come in here, blah, blah, blah. Okay, so when you guys open, let me go to the right place. When you guys open the startupacademy.site, you guys arrive here, okay? It's like more or less like Netflix looking portal. And you guys have the startup finance course here. So you guys can access, you guys have here like several links. Get all the course info, apply now, which is to pre-register, and to pre-register so that you can already see the free content and that you can solve any doubts with us afterwards before making the final commitment. You guys have to apply. We need to accept you, which usually we do, but there are weird cases. And then yes, then you guys can sign up. So what will you see? Like, as I have like the professor account, I prefer to show you in different ways. You're gonna see this presentation that you can access to it in the get all the course info. You guys have a type form for if you guys want to apply, and as I was saying, like name, email, stuff like that. And then if you click on try for free, if you click on try for free, that you had it here, you will be able to see lesson 1, okay? And then these are the videos of the lesson one are already available to you guys for free, as it says here. When you guys sign up and then we're gonna be releasing we're gonna be releasing the content little by little, and you guys will be able to see the whole content. Okay, so for example, you guys will access lesson 3. There are several videos here, and in some, for example, in the practice one, you guys can see the video that explains the practice. Again, very Netflix-like. This is me talking annoyingly, and the files that you guys have related to that video. And also you guys will have the link of all the live sessions. So this portal should be like everything you need, and then you can go like one by one in the course, like reading the pre-read, like watching the videos, and so on and so forth. Okay, so in everyone is the video plus whatever content is attached to it. So I mean, many people are going to end up extremely tired of my voice and of me talking for so long. I'm not sure if I recorded all the videos. I think one is on Luis Fer, but many people told me that they end up dreaming with my voice, and I'm sorry about that. But as you can see, the platform is super easy to use, I think user-friendly, and I hope you guys like it, but of course, feel free to provide any feedback. And again, if you click practice, you would see these links here. These links go to here, which is, let me zoom in a bit. This is the text of the case. This is the data that you need. It's everything in Google Sheets or Google Docs. And this is the solution. We are going to give you the solution of all the cases up front, because there are 2 ways that you can finish the course. Like, you can get the credits. You can either try to, I'll show you here. All the cases have a quantitative section and a qualitative section. If you want, you can do the quantitative section and then the qualitative section starting just from the data. This is relatively painful, but you guys will learn a lot on that. Another way of doing it is to understand the quantitative section while looking at the solution already, and then you have to reply to the qualitative section. In order to get credits, you guys need to send us the answer to the qualitative section or to connect to the live class. Okay. So, where was I? Here. So as you can see, this is the dynamic in every lesson. Pre-read, theory videos, case resolution. Every week, and these are the dates, we're going to have a live session to solve the case. So the introductory session is mostly about how the course works, and then like the other lessons to cover the to review the theory and to solve the case. It's usually 5:30 to 6:30 on Thursdays or Wednesdays. There's a couple of exceptions, but mostly on Thursdays. Until February 26th, you guys can register. The presentation is on the 27th, and the first live session on March 20th. So there's plenty of time now. We have these are 2 examples of people that, thanks to us and the network and the knowledge, found jobs and switched jobs. So we are super proud of this, and we still keep in touch with a big part of the community. And as you see, there's other, we share job opportunities, we try to consolidate the networking and the synergies within the team and stuff like that. And you guys always text me to have a call, whatever. So anyway, typical questions. You guys need prior knowledge of finance? No need, because startup finance is a very niche thing. So I wouldn't worry about that. How long will the materials be available once you have finished the course? Forever. How deep does the course go? I would say pretty deep. Some people are afraid of that, but it's just because from 0 to 10, you can decide how deep you want to get. So if you want to learn absolutely everything and understand every single slide and understand every single course, that's a lot of effort. For many people, they do maybe little, up to 5. They understand the main concepts, and they know that whenever they need anything, it's there, down to depth level 10, to put it that way. Will the content be available if I cannot attend the live classes? Yes, anything we do live you guys will have it pre-recorded. Can payment be made in installments? Up to 3. When we confirm your application, you guys can sign up and click on up to 3 monthly installments. Can I get discounts? If there are referral codes, and if you guys have one, you can have some discount. Can my company pay the course? In fact, it's super common. And what payment methods are available? All of them. In fact, it's also direct debit that it doesn't say here, but that's not a problem. So let's cut to the content, which is probably why you wanted to join here. So this is a standard case of which we have 10 in the course. This is, we try to make them based either on startups that are our clients or have been our clients, or famous startups, so people can relate. This warning is important. All the numbers are fictional and obviously an oversimplified version of the company. It's funny because many times like people raise their hands during a class and say like, well, but I'm sure this is more complicated. I say like, of course, it's more complicated. You know, it's like if you want me to make it super complicated, don't worry that we can. But the most important thing is in 1 hour to get like the 5 things that you cannot miss and the basics. And again, the depth is there. So we encourage you to solve both quantitative and qualitative. However, the solution to the quantitative section is already available. And if you want to skip, you can skip the heavier analytical part of this exercise and move to the qualitative. And to get credit, to get the certification, you guys have to either submit the answers to the qualitative questions by email, I'll say the address in the introductory session, or participate in the live session in order to get 1 credit. Then if you guys get at least 7 out of the 10 credits, you guys get the certification and the diploma. Anyway, again, to the chase. In this case, we are talking about Uber. And this is completely fictional, of course. And Uber thinking of opening in a new country, which is Spain. And they want to launch services in Barcelona. The country manager is carrying out some analysis to understand the unit economics of Barcelona and of Spain as a whole. And you want to verify and understand that the Uber unit economics are healthy. Unit economics, you guys will hear that sentence 1 trillion times, like those 2 words, 1 trillion times in lesson 1 and 500 million in the rest of the lessons, in each of the rest of the lessons. Why? Because unit economics are the absolute base of the startup economics. Like what makes a startup is thinking in unit economics. So the key in startup finance, obviously, is to understand the unit economics. We will see it in the exercise itself, obviously in the theory, in the videos, that again, you guys can access for free the videos on lesson 1 without any commitment. You can see that we explain the concept, of course, and we focus a lot on that. Today, I'm going to explain the basics while I explain the first part of the case. So we love to give a bit of introduction on the company and on like how it's developed. Obviously, Uber is pretty well known, but then we get to the chase. Okay, so the goal at the beginning is to understand if the driver and the customer unit economics in a city that is already stabilized are healthy. So unit economics, this lesson and this case covers unit economics from 4 different points of view. The driver of Uber, the customer of Uber, the city. At city level, we're going to see the city of Barcelona and the country of Spain. And this is super important. If at any point the unit economics are not healthy, the unit economics tell you you are not going to get enough return for the investment you need to do up front, then don't open it, don't do it, close it. This is not successful. This in Uber, and then we can talk a lot of philosophy about this, this proves that how complicated a business like Uber is. Like numbers need to add up very well and very healthily in many different levels. And this is super complicated. So we want to see that for the drivers, the cost of acquiring a driver is by far compensated by the margin that the driver will bring you in time. And the same thing, and in fact, I think it's easier point of view with the customer. The customer that orders an Uber, well, you spend some money to acquire that customer through marketing and sales. And then that customer will use Uber in time, like during years even, and will bring you some margin to the company. So that's the part one, and that's the one we're going to solve. And then I'm going to just introduce the part two that is pretty cool. If you guys sign up to the webinar, if I'm not wrong, you guys have access to these files too. So you guys can, like, if you understood the concept, if you want to play a bit with the files, that would be great. So we know all this data in the city of Barcelona. In an already stabilized city compared to Barcelona. And this stabilized is going to be important. Let's go here, in fact, and let's see how we play with the numbers. Here is the customers part. Again, if you want to solve it, the quantitative part from scratch, you have it here. And then you guys can start playing from scratch. And again, I recommend you to do that, but it can be heavy analytically. And the problem of having a good community, by the way, is that people are busy. So if that's your case, we can start from here. There are customer side. There are 80,000 trips in the city of Barcelona per month, I think. 500 new customers in Barcelona. Well, sorry, in a city like Barcelona. In this city. 20,000 active customers that every month they get an Uber. Average ticket, let's say 15. Take rate of Uber, so what they keep in margin is 10%. And the marketing spending for that city is 15,000 per month. Again, I can say it enough times. This is super fictional. Like, I haven't worked at Uber. In fact, one guy among the alumni worked in the Spanish Uber, and I remember like talking a lot about this case. I was pretty cool with him. And yeah, so like the goal here is to understand the two key parts on unit economics. The lifetime value, how much margin that customer is going to bring you during its lifetime with you, and the customer acquisition cost. How much did it cost you to acquire that customer? And then we are going to analyze the proportion between the two numbers. Again, this is explained heavily in the theory. So there is a tricky part that everyone is like, why? And I admit it's a bit of a trick that I pulled in this case, which is already stabilized city. If we say that it's stabilized, we mean that every month, like that it's flat. Every month we have 20,000 active users. We are not growing. And if we get 500 new customers per month, it's because we're churning 500 per month. This we can, like, you guys will see in the lesson 2, the concept of ARR at maturity in SaaS. And it's super important. Like, I mean, I'm going to introduce it, just that. If every month, imagine that you churn 1% of your clients, of your customers, like you lose 1% of your customers. You have 1,000, you lose 10. And then every month you acquire 20 new customers. The maximum you're going to have is 2,000 customers. Why? Because when you have 2,000 customers, 1% will churn every month, 20, and you're going to acquire 20 every month. So here we're saying that in Barcelona is already happening. So we say that, in this city that looks like Barcelona, if we have 20,000 active customers and every month the churn is 500, then the churn in percentage is 2.5%. 500 over the total base of 20,000. So far, so good. If not, please write on the chat, and Dome will let me know because I don't see the screen with the chat. So this is mathematics, and this I say it long in the theory, but if not, you guys need to believe me, which is like the average lifetime in months of a client, if your churn is 2.5%, is 1 over 2.5%. So 40 months. If you lose, imagine, let's say 1% of your customer base every month, it's because your average customer stays with you 100 months, 8.3 years, I think. In this case, 2.5% churn means that the client stays with us 40 months. On average, of course, unit economics, and this is a very common mistake. Many people don't do unit economics, they do the whole economics. And we're talking here about the average customer, the lifetime value of the average customer and the acquisition cost of the average customer. This many times creates misconceptions, and then it's like, but for many people, it's like, okay, but we have this type of client and that other client. Okay, if we are measuring the customers in general, this is fine. But it is true that you may want to segment this. And by the way, the word segment, you're going to hear it a lot, especially every time we model. What does that mean? That maybe, I'm making it up, maybe it's obvious that you have two types of customers. The ones that use you only on Friday nights and the ones that use Uber daily. I'm making it up. But probably those two will have very different acquisition cost and very different lifetime value. Here we're talking about the average. So again, let's not overthink it. The average customer, if there are 80,000 trips and there are 20,000 active customers, they travel 4 times per month. What does this mean? And this is like a long multiplication. That during 40 months, in each month, like the customer is going to do 4 trips of 15 euros, and Uber is going to keep 10% of that. So for 40 months, Uber is going to make with this guy 6 euros, if I'm not wrong, which would total 240. This, again, you can complicate it much more, but the important concept is that. And then the customer acquisition cost is if we spend 15,000 euros on acquiring 500 customers, each one costs us 30 euros. It is true that it's not often the case that we think, especially even like in bigger B2B companies, we don't think in terms of CAC. You don't say like I put 30 euros somewhere and I get a new customer. But in the end, it's true. You spend a lot of money probably on acquisition, both generating leads, marketing, and closing leads, sales. Here I simplified it just with marketing, but it should be marketing and sales. So all the cost you put divided between the number of new customers that you get is 30 euros. Does this mean that if you put 30 million euros, you acquire 1 million new customers? No, obviously not. CAC scales all right, but you need to be aware of the size of the market, of course. I always give the same example. There was this company during pandemic in Spain called We Are Kneaders. In fact, they were our clients for a while. And their acquisition cost during pandemic was pretty low. But their acquisition cost afterwards, and once they had a huge customer base, because they did, obviously is much higher. I always say the stupid thing, like it's way easier to get my mom in We Are Kneaders and to do knitting, punto de cruz, that we say in Spanish, than to get me to do it. So maybe you need to spend so much more in marketing around me and in social networks and discounts and everything for me to try. So the CAC doesn't scale that well. But the key thing here is to compare with the market size. So, and here now is the Bible. And if you need to understand one concept about startup finance, is the following. The proportion between LTV and CAC should be above 3 and probably below 10. Okay, sorry, in fact, this. Okay, this is the power of the LTV over CAC. The LTV over CAC, imagine that is super high. So imagine, for example, that like SAP, the company SAP. Many of you guys may know it, that it's an ERP that for big corporates. Like their customers are companies like P&G, they are companies like, I don't know, Microsoft, things like that. that they use it worldwide. So obviously those licenses are literally on the tens of millions and for many, many years. Okay. So that like 50 million contract over whatever number of years is going to bring a lot of money to SAP. The LTV is going to be huge. Like the margin is not 100%, but still maybe like 50 million, 80% margin, 40 million. Wonderful on the 5-year contract. But do you think you can sell it just with an ad on Instagram? Or maybe you need very experienced, very expensive salesmen. Maybe it takes them 3 years to sell it. Maybe you need to do a proof of concept for free. Then maybe the CEO of SAP needs to travel to Seattle to sell it to Microsoft and things like that. Maybe, right? For a contract like that. So a business that has very high LTV usually has always has very high acquisition cost, customer acquisition cost. Let's do the opposite example. You're selling candy. You're selling candy that literally a gum is 10 cents. Fine. A chewing gum, it's 10 cents. Fine. But maybe your only marketing is that you print it like, that you are in a nice spot and like with some location, and that's it. Okay, you didn't spend almost like the guy that buys candy is gonna give you over 3 years maybe a margin of €3, but you are not spending much per guy that that gets to come to your store to buy candy. So I hope you guys got it, and if not, please write it on the chat. It is not possible to sell Ferraris that are very expensive and have very high margin for the company. It is not possible to sell Ferraris 100 per month in a store with one intern. It doesn't happen. You may sell 2, you may sell 4, I don't know, whatever, and maybe the salesman is more experienced. And then if you compare one versus the other, then you see that the proportion is 5. And that's great. Why is this so powerful? It's so powerful because, by the way, what happens if it's too low? Well, maybe that guy sells one Ferrari per month. Maybe I'm making it, let's say per year to exaggerate it. Maybe the store keeps 50,000 margin, but they pay the salesman 50,000. So what a business in which when you acquire a customer, then the only money that will bring you is just to cover the acquisition of that customer. This in startups is especially important because you spend a lot of money now to acquire a customer, and many times then it's the customer will pay you, let's say, €20 recurrently. For a long time, you are going to be in losses, but at some point, you are going to be in profit, and then, break even, and then in profit. So this is super powerful. This is in any business. The LTV over CAC must be healthy. But what if it's too healthy? Why did I say lower than 10? Because I don't believe that people can sell Ferraris with interns. So many times we open a business plan of a company that hasn't started, and they tell you that next year they're going to have 2 salesmen and they're going to sell 100 new customers for this fee. And you do the unit economics, and then you realize that it's impossible. That the guys are effectively claiming that they're going to sell huge SAP licenses with interns. So that's the power of it. And also, if you look at the past and you see that consistently they have been pretty healthy, let's say in 8, you can say, nice, let's keep acquiring customers. And here's a very important concept. Again, I'm explaining very fast what you guys will see in the theory and in the complete case. This is why VCs invest in big chunks of money. So you tell me that this is going to happen, like this. Imagine, like for a very long time. So this is profitable. In fact, let's do it more exaggerated. You see that the client is going to give me 640, and now I need to spend 200 to acquire it. Okay, I believe you. Let me give you 200,000, and then you will start generating 40,000 per month. And in 5 months, we will have recovered it, and then the rest is profit. You prove that works? Nice. Then you didn't run out of market, you knew how to execute, you're going to start in a new geography, whatever. Nice. Now I'm going to give you 2 million. I'm going to give you 2 million and you acquire like 100,000, is it? No, like 10,000 customers. You prove that you can do that. Okay. I'll give you 50 million. Okay. So I'm talking all this about the customer point of view. In this case, let's take 1,000 steps back to Uber. The proportion is 8. You're going to spend 30 euros in acquiring someone that will bring you 240 euros in gross margin in time. Nice. Congrats. You have a great business. Again, I'm making up all the numbers. And what is the payback? The payback in this case will be 5 months, for example, in the example I just painted, which is the time that it takes to recover your initial investment. So in fact, in this example, it's also 5. The formula is slightly more complicated, but you guys would get it. Essentially, like the number of months, the division between the CAC and the monthly margin that you get. So, by the way, payback is also a very important KPI. And especially VCs like it to be less than 12 months. Why? Because if the payback is too long, it's like, I don't know if I'm going to be alive to reap the benefits. Imagine I tell you, this is, well, let's say minus 100, and every month I get €1 back. Well, this will take you 8 years and 4 months to get back the money. And then starts the profit euro by euro. So yeah, maybe the client is going to stay 30 years with us. Wonderful. Obviously, you haven't had time to prove that the client is going to stay 30 years with you, obviously. But even if we believed it, it's like, I don't know, I'm more impatient than that. I want to recover it in less than a year. Hope you guys are following, and if not, please write on the chat. It is an extremely powerful concept. Something that happens a lot when people show me unit economics and they say LTV over CAC 65, that they are not putting the real acquisition costs. So, for example, the company spent 1,000 euros in the website. Fine. They don't have salesmen. They don't have more marketing. And they acquired 10 clients. Wow. Each customer cost us 10 euros, right? Or 100 euros. I don't know the numbers I said, like very cheap. And they return so much money because they stay with us for many years, returning a lot of money. Fine. I'm 100% sure that the sales are being made by the CEO. And maybe you didn't put the CEO in marketing and sales spending. And it's a real one. And even if you do, maybe the unit economics are still 20. Like LTV over CAC is still 20, super high. I was like, Jaime, we got you because we are now allocating the CEO's time as sales and marketing. No, because that doesn't scale. Because you cannot put as a second CEO, like you cannot replicate the CEO and get twice as many clients. In my own case, obviously I acquired my network, but like you don't put 200 euros on the website and then you double the number of customers. So the CAC, it should be something that in the short term, if you double the expense, you double the new customers that you are going to get. All this to say that Uber on the customer side is pretty healthy. What about the drivers? And this part is often overlooked. The customer acquisition cost and the customer unit economics, I think, is, let's say, relatively well known, or like an exercise that people know that they need to do. But in this case, there's another part of the marketplace, and we're going to see what dangers may be here if these unit economics are healthy, but these ones are not. By the way, in marketplaces, it is usually like this. The supply is the problem. We acquire 50 new drivers. There's an active base of 500. Average ticket and take rate are the same. We spend more money on marketing. Churn, 10%. Because every month we acquire 50, we lose 50 out of the 500 that we have. 10% churn means 10-month lifetime. Trips per drivers, 160. 80,000 trips divided by 500. LTV, higher. Every time you get a driver, you can expect that thanks to that driver, you're going to get 2,400 euros. Wonderful. And the CAC is also higher. Okay, then I need to do more marketing. Maybe there's someone from the supply team calling the new drivers. You need to do training and all that stuff. The proportion of the two is 6. So far, so good. The payback is 2. That's amazing. You spend 400, and the first month they give you 200 in margin, and the second one 200 in margin, and you recovered it. But one thing is that unit economics are extremely powerful, and you may have noticed that I love the concept. And another point is that they are everything, and they are not everything. Where is the danger here, in my opinion? Here. Your drivers churn a bit too much. Every 10 months, on average, they leave. And I wonder when you may run out of potential drivers in a city like Barcelona. I have no idea, to be honest. But if you need to acquire so many because they are not staying with you, then at some point, maybe all of them have already gone through Uber, and they decided to stop. So this is an example of healthy unit economics in general, like whatever. This is an example of healthy unit economics, but essentially. So what may happen in this one is like that this at some point is like you realize that with the 20,000 you stop acquiring 50, you start acquiring 5. If that's the case, well, in fact, I mean the formula would jump. But if that's the case, the CAC is 4,000 and the LTV is 2,400, and you start declining on the number of drivers, and that's a problem. So, of course, by the way, in Academy, like we don't want to super focus on the formulas and things like that. I think you guys can learn a lot of Excel, but that's on you. But rather the business sense, and like we want you to feel the ownership with the cases of like, okay, if it were me, what would I do? And in this case, what you should do is to worry a bit about this thing. Okay, all this is on the units, customer and driver. And by the way, here is the quantitative section in case you want to build it from scratch. Like I said at the beginning, now it will be easier. And down here is the qualitative section. And this is the one that you guys will need to either send in advance or you guys connect to the class in order to get credit. Is the customer churn rate good or bad? Why? And of course, there's no right or wrong answer. So like unless you guys replied in blank, if we see that you guys made an effort, we consider it like that. LTV CAC ratios healthy or sustainable. What would happen if the driver was blah, blah, blah. Several questions that I think we have already mentioned. So yeah, like as you see, some qualitative questions, even if you start with a solution, that as long as you understand the case, you follow the case, you compare with the numbers, we hope that you guys learn, which is the only objective of Academy. And I'm gonna just introduce the part 2 of this case. By the way, I went a bit deliberately slow because we haven't covered the theory before, but still in the live sessions, even if you guys cannot see all the theory videos every week, whatever, in the live sessions, I always remind the most important concepts, of course. So what about the part 2? The part 2 says like, all right, what about the unit Barcelona? And what about the unit Spain? So we see that like every city, at the beginning you open it, you start like spending some money and still there is no revenue. You need to assign a team, you need to prepare it. By the way, I make all this up, of course. Then you enter in an MVP phase that you start spending like with this marketing, you start having these trips, whatever. Then expansion, then stabilization, and then saturation. But it's like, you know, Uber in Barcelona cannot have 3 million trips per day, ever. So forget about that. So in the data, we have the P&L of a city comparable to Barcelona in time for 7 years. I think we modeled it. You see at the beginning, no revenue, and then some revenue, blah, 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 and some cost. Again, I'm going fast. If you guys spend time and play with the file, you guys would see it. And then they tell us like, okay, so the city of Barcelona that resembles that one What is the necessary investment until it is profitable? When will it break even? That I'll explain now. When is the payback month? When will we recover all the initial investment to open it? And what is the annual city net profit of Barcelona once it reaches saturation? So the necessary investment is going to be all the, like here we accumulate the losses or the earnings. And here there's a minimum, which is here. The city at the beginning loses money because you are exploring. You have like too many people and too much marketing and whatever, and not so many trips. Until one day it breaks even. It starts nor losing nor earning money, or starts earning money. And by that day, you will need to have invested 458,000 euros, which is this figure. Again, I'm going to go super fast. And this we can talk a lot, but I prefer to go to the important concept than to the numbers. Break-even month on the 20th month. On the 20th month, you start making money. Payback month. On the 20th month, you start making money, but it needs to compensate all the losses, the 460 that you invested. Aha, here. In month 38, all the money you put, you have recovered it, and now everything else is profit. And once the city is in saturation, like nor growth nor decrease, they are going to give you 900,000 euros, almost a million euros per year. So this is a unit. And the important thing is that everything is a unit. So when Uber opened, they opened in San Francisco. And at the beginning, someone needed to believe that this was going to happen. So they gave them enough money to start testing San Francisco. Maybe, and I'm going to make it up, 200,000. So they can see that at least you guys can start selling. Something like that. Maybe 300,000, maybe 500,000. In fact, I think it's in the case. But the most important part is the concept. Then, if you see that one unit is going well, the unit San Francisco, probably they say like, can anyone give us money to open New York, Miami, and Chicago? And someone says, well, one city, they are not even making money, but at least they are growing fast. So if they keep growing fast and not increasing the cost, this will be profitable. So someone says, fine, I'll give it to you. And then they say, 20 cities in the US, more money. Then they say, we're going to open in another country, in London and Paris. Fine, because internationalization is always very hard. And things go well. And then they say, let's open Barcelona. And this is the plan that we have. So these are the famous J-curves that you need to paint in this picture too. So, and this is why, and this is the important concept here on the startup financing side, this is why startups lose money during a long time. Okay, like my father never understood why, like in almost all of our companies, they lose money. And to me, it's like you can do it well or you can do it wrong. Like you open a city, you're gonna lose money during 20 months. But maybe once you are proving that things are going well, maybe you want to open another one or another 3 or another 10. And then you open one every X months. And this is why your units are doing well, even though your company is losing money, but it's losing money in a calculated way. Several stars to this message. One, it may not be the case. It may be that San Francisco was easy and New York was not. You may have a terrible city manager in London that like screws up the city, or maybe it's because the service doesn't apply in London. Maybe in Barcelona, and by the way, this was the reality, you get hit by the regulation, like completely. So then maybe like there are problems here. So it's all theory, and like this is why startups like can be losing money, because the second part of the second part is how about we open 16 cities in Spain. And we see that in this scenario, we lose money during 28 months, which is longer. But I mean, these obviously are numbers we can play with. But maybe at the same time that you're opening Spain, you're opening another 5 countries, and you start here and you start here. So all this line is going to be negative for a long time, with the promise that all these units are going to explode at something. By the way, you have competitors. This is partly why you want to go fast. And you start diluting yourself, you start giving away parts of the company. But you want to be the winner here. Of course, this is very risky. This doesn't mean like a company losing money is fine. No, wait. This is why we need to look at the unit economics. So, for example, we fight with banks on a daily basis. On behalf of our clients, we need to get them bank financing if we think is the most appropriate thing. And many times they don't understand because they are not used to it, because SMEs usually don't work with unit economics or in a scalable manner. They don't understand that. They say, okay, the company is losing money. And to me, it's like, did you look at this? Did you see that the cities are breaking even after 20 months? And then they bring you 1 million per year, which is wonderful. And you just need to invest this. Can you please give me part of this money? The other part, I'll get it in equity. Fine. Can you give me part of this money that it has already worked in many other cities? So again, any business related to investing and our lending money are risky, even if you have past unit economics that are healthy. And even more in startups, because it's new technology. So maybe all this is a dream from the beginning and nothing works, because many times the regulation catches up, especially in Europe, or things like that. Or not all the markets are what you thought, or the markets are smaller than what you needed, or there's no product market fit, or 1 million things. But again, the logic I want to tell you is, why do startups lose money for a very long time? How it can be good or it can be bad depending on the unit economics. And by the way, all these need to sustain the headquarters over here. And in the lesson, both in the theory and in the practice, we're going to cover all these definitions and all these concepts, I hope, until you guys are exhausted, because they are very important. And in the case, we're going to solve it and discuss all of this. So I don't want to take more of the time than I promised. And of course, like every class, we try to be spot on in terms of timing. We always start with a 3-minute delay, something like that. But then we try to finish right on time. So what would I encourage you to do? To go to the website, to click on Get All the Finance course, to click on Apply Now to get even more information, and to start seeing the free theory videos. At least skim through them. Like, just make sure that like you understand and you see the type of content that we share. In this case, if you guys want to deep dive, review, whatever, I will be more than happy. If you guys want to send me an email, you can do it jaime@tscfo.com, or if you want to send an email to the team with any doubt, academy@tscfo.com, stuff like that. As you guys saw, this is the case of the typical lesson. In, I don't know if it's 1 week or 2 weeks, but we're going to cover one in the other side of the business, which is cap tables. I admit that lesson 7 and lesson 8 are my favorite, because they deal with humans. And these lessons, even if it's pure numbers, it's about like what every investor and what every CEO is thinking of, and like what are the incentives of everyone involved. And it's essential, especially if you are starting a startup or in finance. This one is super cool. So we'll do it next week or in 2 weeks to convince you, I hope, of joining the whole course. And well, I hope to see you there.